Good afternoon, everybody. Good afternoon, everybody. Welcome. I'm Verna Williams. I'm the Dean of the College of Law, and it's my great pleasure to welcome you to this year's Robert S. Marx Lecture. Now, just by way of background, Judge Robert Marx is one of many storied figures in the college's history. He graduated from Cincinnati Law in 1909 and had a distinguished career as a jurist, litigator, and thought leader. Among his many accomplishments was founding the Disabled Veterans of America. He established this lecture to enrich our curriculum by bringing preeminent scholars to discuss current legal issues. This year's speaker is no exception. Dorothy A. Brown, Asa Griggs Candler Professor of Law at Emory Law School. Professor Brown is a native New Yorker, the daughter of James and Dottie Brown. Her parents achieved the American dream, home ownership, thanks to a loan from Mr. Brown's boss. At the age of 10, Dorothy witnessed a police officer beating a handcuffed Black man in the back of a cruiser. In her book, The Whiteness of Wealth, Professor Brown says that was a transformative moment, one that led her to tax law of all things. She writes, I learned early on that people might look at me and see Black, but as far as tax law was concerned, the only color that mattered was green. Tax law was about math, and I was sure I'd chosen a career where race had nothing to do with my work. Like all good stories, this one has a twist. Professor Brown was wrong, of course, and now Professor Brown is a nationally recognized scholar in tax policy, race, and class, who has published extensively on the racial implications of federal tax policy. She is a public academic, a respected speaker in the legal community, and a regularly engaged media expert, appearing in such outlets as Bloomberg, CNN, NPR, the New York Times, National Law Journal, and Forbes. Professor Brown joined Emory Law School in 2008 after having taught at Washington and Lee University School of Law for 4 years. At Washington and Lee, Professor Brown directed the Francis Lewis Law Center, whose mission is to support serious research advancing law reform. Professor Brown also was on the faculty at George Mason University and right here at the College of Law, where our paths crossed only briefly. Throughout her academic career, Professor Brown has earned many accolades, including the American Association of Law Schools Clyde Ferguson Award, which is given to outstanding law teachers who have achieved excellence in the areas of public service, teaching, and scholarship. Before becoming a law professor, Professor Brown worked as an advisor to J. Stephen Swift of the U.S. Tax Court, as an associate with Haynes and Miller in Washington, D.C., and as an investment banker at New York's Drexel, Burnham, and Lambert. She also was a special assistant to the Federal Housing Commissioner at the U.S. Department of Housing and Urban Development. Professor Brown earned her JD from Georgetown University Law Center, her LLM in tax from NYU's School of Law, and her BS from Fordham University. I'm certain that today's lecture is just the type of event Judge Marx envisioned. Please join me in welcoming Professor Dorothy Brown.
Thank you so much, Dean Williams. I'm delighted to be here. And today I want to talk with you about the making of the whiteness of wealth, how institutions shape academic thought. Let's begin by traveling back in time to the early 1990s when I was on the faculty at then George Mason Law School. One afternoon, I wanted to take a break from class prep, and I had been saving a law review article for just such an occasion. It was an article written by my friend and mentor, Duke Law Professor Jerome Culp, toward a Black legal scholarship, race and original understandings. In it, he argued that all Black law professors should analyze whether race has anything to do with the area of the law that we teach. I was almost finished reading the article when I saw the following line. There may be an income tax problem that would benefit from being viewed in a Black perspective, but until you look, how will anyone know? Before reading that article, it was inconceivable to me that tax law could operate differently based upon race. I picked tax law, or perhaps tax law picked me, so that I could get away from race. Growing up in the South Bronx and New York City and experiencing racism made me feel angry, frustrated, and powerless. Specializing in an area of the law that I believed had nothing to do with race seemed like a very good idea. Tax law was all about numbers, and I love numbers. Numbers are neutral and objective. Green was the only relevant color, right? But that afternoon, I began to question everything. After I finished reading, I called Jerome and made him a promise. I would look to see if tax laws impact taxpayers differently depending upon their race. Keeping that promise was not easy because I found out that neither the IRS nor the Treasury Department publishes statistics by race. I think it is important to pause for a moment and reflect on that. If the tax experts do not publish the data, then any racially disparate impact will continue unabated, invisible, hidden from the naked eye. Further, the absence of tax data by race reinforces the idea that taxes are colorblind. As you know, many government agencies routinely provide race data, but not the Treasury or the IRS. What my decades-long research shows is that when Black and white Americans engage in the same activities, tax policy subsidizes white Americans while disadvantaging Black Americans and results in their financial death by 1,000 cuts every April 15th. That means we have to rely on this academic's quixotic journey over the last 25 years. So let's talk about my journey and the significant role that the University of Cincinnati plays in it. The first thing I ever wrote about race and tax was the last thing that went into my tenure file at Cincinnati. Spoiler alert, I got tenure, so it worked out. That piece was a chapter in a book called Taxing America and was published by NYU Press. My chapter, The Marriage Bonus Penalty in Black and White, looked at how husbands and wives contributed their income to the household and the impact of the operation of the joint return had on their tax bill. The chapter talked about how white married couples were more likely to have one wage earner in the paid labor market and one stay-at-home spouse. Those households received a tax cut when they got married. We call that the marriage bonus. On the other hand, couples where husbands and wives earn equal amounts of income do not get a tax cut. Their taxes increase. We call that the marriage penalty. I followed up the book chapter with a more in-depth article, and I could do it only because I was on the faculty at Cincinnati. I was able to work with Mark Carrazza at the Institute for Policy Research, who analyzed Census Bureau data for me as a proxy for income tax data to show household income contributions by husbands and wives. The research showed that regardless of income, Black married couples pay higher taxes than white married couples because Black married couples are more likely to live in equal wage earning households. Having the ironclad data that the Institute provided helped support my goal of producing high quality research and would influence future work. My move to the faculty at Washington and Lee Law School would prove pivotal in my intellectual journey. It started with an offer to visit and the dean asking me to teach a course in critical race theory. I thought critical race theory in Lexington, Virginia, didn't he want the visit to go well? But I digress. I thought, okay, let's do it. Even though I had never taught critical race theory before. And I'm a tax lawyer, so I am kind of a data person. Well, not kind of. I'm a data person all in. The thought of a touchy-feely, let's talk about racism in America and holds hands class was not anything I was particularly interested in. So I knew I would have to put together an original set of materials, but first I had to figure out how I was going to go about doing this. I decided that I would put together materials on the first year of law school because my second and third year seminar students would have all taken first year courses. I put together separate chapters on torts, contracts, criminal law, criminal procedure, civil procedure, and property. That sounds like a great idea, right? Except for the fact that I don't teach first year courses. So between the time I received the offer to visit and when I actually taught the course, I bugged every friend I had who taught first year courses. They gave me cases. I was able to put together excerpts from law review articles. In doing the research for the book, reading the articles, and getting immersed, it really opened my thinking about how to tackle the race and tax project that I had embarked on in the mid 1990s. You will never think the same way about the law once you read Cheryl Harris's Whiteness is Property. Ultimately, I put those materials together in my book on critical race theory, and I am currently working on the fourth edition. The next leap forward in my research occurred when I moved to Emory University, because it was there that I met amazing Black colleagues in other disciplines who taught me the value of interdisciplinary work and resulted in my talking less and less to legal academics and more to other scholars. I was appointed a co-director of the university's Race and Difference Initiative and worked closely with sociologists, historians, and political scientists. As a result, my work became interdisciplinary and better. I learned how to ask different questions and came up with more nuanced answers. Historians made me ask, how did we get here? Sociologists made me think more deeply about the impact that a society built around anti-Black racism had on tax policy. Political scientists made me ask more questions about why laws benefiting white Americans were enacted and not laws benefiting others. Stratification economists taught me to think about economic inequality as a function of societal racism. Each of those disciplines taught me to ask more insightful questions that led to different revelations and ultimately to the whiteness of wealth. So the balance of my talk will be about the fruits of the support I received at Cincinnati, Washington and Lee, and Emory, namely the research published in my book. My chapter on marriage, Married While Black, showed that tax subsidies for marriage benefit white Americans more than Black Americans. The research reveals that African Americans are the least likely to marry. When they marry, they do so later and spend less time married than white Americans. And they are the least likely to stay married. The majority of white Americans are married, the majority of Black Americans are not. As a result, tax subsidies for marriage will disproportionately benefit the majority of white Americans. My research shows how subsidies for marriage disproportionately benefit white married couples while disadvantaging Black married couples. It begins with the marriage bonus, which provides a tax cut for married couples in single wage earner households. The single wage earner pays less taxes on their joint return than the single wage earner would pay had they remained unmarried. My research shows that single wage earner households are more likely to be found among white married couples. The marriage penalty, on the other hand, describes the tax increase for married couples when both work in the paid labor market. The marriage penalty is the greatest when married couples are in roughly equal wage earner households, when couples contribute 50-50 to household income. Those couples pay higher taxes when they get married than they would have paid had they remained single. My research shows that Black married couples are more likely to be equal wage earner couples than their white peers. In other words, tax policy decisions contribute to a married Black couple's inability to create more wealth. What we know of as the joint return did not exist at the beginning of our progressive tax system because taxpayers were taxed on their income as individuals. But in 1927, a rich white couple, Charlotte and Henry Seaborn, along with their lawyers, took matters into their own hands, effectively creating a joint tax return for themselves. Henry shifted half of his income to Charlotte, which lowered the overall taxes they paid. The Internal Revenue Service objected, but the Seaborns took their case to the Supreme Court, which rewarded their self-help with a win. That led eventually to Congress creating a joint return in 1948. But even in 1948, a higher percentage of Black wives worked outside of the home than white wives, which meant it was entirely predictable that the joint return would lead to lower taxes for more married white couples than married Black couples. It is referred to as equitable when we tax two households with 100,000 of income the same, whether that is the result of two wage earners or one. Systemic racism in the labor market, however, means that it often takes two married Black workers to equal one single white wage earner. Those households should not pay the same amount in taxes in a progressive tax system. That is the opposite of equity. A study of Black and white families over a 25-year period between 1984 and 2009 showed getting married significantly increased the wealth holdings for white families by over $75,000, but had no statistically significant impact on African Americans. I believe the marriage penalty disproportionately paid by Black married couples during those years is part of the reason why. And while the 2017 tax cuts temporarily eliminated the marriage penalty for many married couples, it did so by significantly increasing the marriage bonus and by leaving intact the significant marriage penalties found in the earned income tax credit. So even if a Black married couple does not pay higher taxes today, their white peers get a tax cut that they are ineligible for. In addition, the 2017 Tax Act did not eliminate the marriage penalty for high-income married couples. And there is a higher percentage of high-income Black married couples paying the marriage penalty when compared with their high-income white peers. There is also a singles penalty in our tax laws. A single worker with 50,000 of income will pay higher taxes than a married couple with a single wage earner who earns $50,000 of income. The marginal tax rate for the single taxpayer is 22%, compared with 12% for the married taxpayer. Almost half of Black Americans are single, compared with just over a quarter of white and Hispanic Americans. As a result, Black Americans are disproportionately paying the singles penalty along with over a quarter of other taxpayers. My proposed solution is a repeal of the joint return, which only entered the tax code in 1948. It would immediately eliminate the marriage penalty and singles penalty currently being paid by hardworking Americans. No longer would their extra tax dollars subsidize certain married taxpayers that are disproportionately white. The repeal of the joint return would mean that Black Americans currently paying higher taxes would have more money available to save towards building wealth. My homeownership chapter, Black House, White Market, showed the majority of white Americans are homeowners while the majority of Black Americans are renters. According to the Census Bureau, the highest rate of homeownership was for white Americans at 74%, and the lowest rate was for Black Americans at 44%. As a result, all tax subsidies for homeownership will disproportionately benefit white Americans the most and Black Americans the least. Homeownership has been and remains historically an asset tied to racial identity. Recent data show that roughly 1 in 10 Americans itemize deductions, and those are disproportionately Americans with higher incomes. The mortgage interest deduction, which can only be taken if a taxpayer itemizes their deductions, is becoming increasingly irrelevant to most homeowners. There are other tax subsidies for homeownership, however, that includes the tax treatment when we sell a home at a gain. Gain on sales of homes can escape taxation for up to $500,000 if the taxpayer is married, or $250,000 if the taxpayer is single. Losses on the sale of homes, on the other hand, are not deductible. The special tax treatment for gain dates back to 1951. By 1950, 55% of white Americans had become homeowners. Just a decade earlier, only 44% of white Americans were homeowners. That explosive white homeownership growth was aided by low-cost, long-term, fixed interest rate mortgages insured by the federal government that largely excluded Black Americans. From its origins, the tax break for gain on home sales was designed to benefit white homeowners. Established research shows us that the greatest appreciation in our homes comes when we live in neighborhoods which are overwhelmingly white with very few Black neighbors. As the percentage of Black homeowners in the neighborhood increases, the value of the homes decrease, particularly because white home buyer preferences, as the majority of home buyers, help establish the market prices. While most white homeowners live in neighborhoods with very few Black neighbors, the majority of Black homeowners live in racially diverse or all Black neighborhoods with many Black neighbors. As a result, white homeowners, but not most Black homeowners, are more likely to sell at a large tax-free gain. Research also shows that the homeowners most likely to sell their homes at non-deductible losses are Black. Tax subsidies for homeownership, therefore, create white tax winners and Black tax losers. The federal government should stop subsidizing a racist homeownership market. We should repeal all tax subsidies for homeownership, period. My chapter on college, The Great Unequalizer, showed how tax subsidies for higher education contribute to the Black-white racial wealth gap. Black college students leave college with more student loans than their white peers. The average Black college graduate has $7,400 more in student loans than the average white college graduate. Excuse me. 4 years after graduation, however, Black Americans owe an average of $52,000 in student debt compared with $28,000 for white college graduates. And the gap is present across income levels. Not even wealthy Black taxpayers can protect their children from higher student loan debt. Wealthy Black parents cannot protect their students from college debt the way their white peers can, because wealthy Black parents hold assets differently from their white peers. They have more invested in their homes and less invested in the stock market. In addition, direct plus loans, which have higher interest rates, are also more common among Black families. But why does Black college debt grow over time, while white debt is reduced and paid off? Black college graduates are more likely to attend graduate school compared with their white peers, and more likely to have graduate school debt. Any college debt repayments will be deferred while the student is in graduate school, increasing the principal loan balance over time. Coupled with income-based repayments, which Black college graduates use almost twice as much as their white counterparts. While created with the best of intentions, deferred debt and income-based repayments are contributing to an ever-increasing Black student debt problem. Tax policy does not help matters here. The deduction for interest on student loan debt is limited to $2,500 per return and subject to income limits. By my calculations, with Black debt at $53,000 and white debt, student debt at $28,000 in the first few years, Black Americans are more likely to be unable to deduct all of their interest because it exceeds the $25,000 limit. White Americans, on the other hand, are more likely to be eligible to deduct all of their interest. Student loan debt contributes to the racial wealth gap. Researchers have placed student debt at roughly 10% of the racial wealth gap when a college graduate is 25 years old. But by age 30 to 35, it explains about 25% of the gap. I have two solutions. One, increase Pell Grants, and two, student debt forgiveness. According to the Center for Budget and Policy Priorities, Pell covers just 29% of the average cost of tuition, fees, room and board at public four-year colleges, far below the 79% it covered in 1975. Pell Grants have obviously not kept up with the rising cost of college. Pell Grants are awarded by income, and roughly 70% of Black college students receive them compared with 34% of white students. Increasing the amount of Pell Grants should enable future generations of Black college students to graduate with significantly less debt. And the funding should come from a tax on not-for-profit colleges and universities with at least $750 million in endowment funds. I support targeted debt forgiveness for those in households with below median wealth. Debt forgiveness should also include not just student debt, but parental debt, similarly to the way the Morehouse Debt Forgiveness Program was structured. Congress must ensure that any forgiveness is tax-free for those whose debts have been forgiven. My chapter, The Best Jobs, shows that tax subsidies for employer-provided retirement accounts are more likely to benefit white workers. Occupational segregation in the labor market is the reason why. Retirement accounts as a tax benefit traces its roots to 1942. When price and wage controls, along with an excess profits tax, encouraged employers to provide non-wage benefits like retirement accounts. Amounts set aside in retirement accounts by employees, and if there's an employer match, amounts set aside by their employer, are not taxable to the employee until their expected withdrawal at retirement. If any amounts are withdrawn prior to the age of 59 and a half, they are subject to an additional tax penalty. Black Americans are less likely than white Americans to work for employers that provide retirement accounts. In the private sector, for workers aged between 21 and 64, 56% of white workers work for an employer that offers a retirement plan, compared with 50% of Black workers and almost 35% of Hispanic workers. Almost 46% of white workers, almost 37% of Black workers, and 25% of Hispanic workers actually participate in their private sector employer-provided retirement account. Research also suggests that Black workers are more likely than all other racial and ethnic groups to take an early withdrawal regardless of income and pay a tax penalty. One potential explanation could come from research that shows Black college graduates are more likely to send money home to their parents and other family members in financial distress, while white college graduates are more likely to receive money from their parents and other family members that enable them to be able to save more and build more wealth. Black college graduates have to make their dollars stretch farther than their white peers, which makes it less likely for them to be able to contribute to their retirement accounts and more likely to withdraw what they may have been able to contribute. Given that less than half of white workers, a little over a third of Black workers, and a quarter of Hispanic workers in the private sector participate in their retirement accounts, tax subsidies like the deduction for compensation should be withheld from employers until the private sector increases their participation rates. My next chapter, Legacy, shows how tax subsidies for gifts and inheritances increases the Black-white wealth gap. The median household wealth of a white high school dropout is greater than the median household wealth of a Black college graduate. Part of the explanation lies in family financial transfers. Research shows that gifts and inheritances explain about 5% of the racial wealth gap. That study followed families over a 25-year period and showed that white Americans were 5 times more likely to inherit than Black Americans. Among Black and white Americans who actually received an inheritance, white Americans received about 10 times more wealth than Black Americans. For each dollar inherited, white families were able to use 91% to increase their wealth, compared with only 20% used to increase Black wealth. One explanation is that Black Americans have extended family members who were alive during Jim Crow and received fewer opportunities to build wealth because of governmental discrimination. And they are now supporting lower income family members, right? They're being supported by those college graduates with higher earnings. Black college graduates are more likely to send money to their parents, depleting their wealth, while white college graduates are more likely to receive money from their parents, enabling them to build wealth. Once again, tax policy exacerbates the racial wealth gap. Gifts and inheritances are received tax-free. Financial transfers by Black Americans to help support family members are not tax deductible. Those without wealth do not have tax breaks to help them build wealth. I believe tax-free family financial transfers help explain why white households with a high school dropout have more wealth than that found in households of Black college graduates. Gifts that lead to wealth building should be included in taxable income, but not gifts that cover family financial needs. The preferential rate for stocks should also be repealed. We should tax income from labor the same way that we tax income from capital. My final chapter, What's Next, provides solutions as well as recommendations for dealing with the current reality. My first recommendation, you can already guess. The federal government needs to publish race and tax statistics. My ideal federal income tax system would have fewer deductions, exclusions from income, and loopholes. All income would be taxed under a progressive tax rate system. My ideal tax reform proposal would be the enactment of a reparations tax credit available to Black Americans as compensation for the decades of higher taxes paid. It would be a refundable tax credit that would offset any taxes owed, and if the credit amount were greater than the taxes owed, the difference would be refunded to the taxpayer every April 15th. It is only an ideal because unfortunately, the Supreme Court would likely find the tax unconstitutional. What the Supreme Court would find constitutional, however, is a tax credit based upon wealth. Enter my second best proposal, a refundable wealth tax credit that can help reduce the racial wealth gap. A refundable wealth tax credit would apply to all taxpayers living in US households with below median wealth, which is roughly $100,000. A wealth tax credit would help low wealth taxpayers regardless of race and ethnicity. And while it would help white taxpayers in low wealth households, the racial wealth gap means that the effect would disproportionately help Black taxpayers because of the racial wealth gap. In 2016, 83% of Black households had less net worth than the median for white households. A refundable wealth tax credit is different from the earned income tax credit in that it is a measure of household wealth, whereas the earned income tax credit is a function of income. In addition, While the earned income tax credit is extremely complicated, a wealth tax credit would be quite straightforward to implement. It could be a fixed amount that each taxpayer is eligible to receive, eliminating any possible confusion as to the amount of the credit claimed. If the taxpayer lives in a household with below median wealth, the taxpayer is eligible for the refundable wealth tax credit. It could be a tax credit that ends after a term of years or after the wealth gap decreases or continue in perpetuity. The idea of a refundable wealth tax credit is the important point, and the actual details should allow for flexibility in order to obtain political support. A refundable wealth tax credit could help low wealth family members that are currently being supported by higher income relatives, which is relatively common among Black families. For far too long, Black Americans have paid higher taxes than their white peers, and fairness requires a significant change to the status quo. A refundable wealth tax credit would be a start. Am I optimistic about whether any of my reforms will become a reality? In January of 2021, President Biden signed a racial equity executive order calling for government agencies to disaggregate data by race. I would have expected Treasury and the IRS by now to have released some information on how they plan to proceed. The IRS commissioner has done nothing but suggest this is Treasury's job. Treasury, on the other hand, has made some initial moves. In October, Treasury appointed the first ever counselor for racial equity and announced plans to create a racial equity advisory committee at the Treasury Department in the future. In mid-December of last year, the Treasury Department announced that they would begin work on analyzing COVID relief payments by race. It's a start, but not a particularly ambitious one. I do have some reason for hope, but in the Government Accountability Office. They are moving forward with a race and tax project that I and several others were interviewed for last summer. Their report is scheduled to be released this April. While my scholarship was nurtured by the infrastructure at Cincinnati, Washington and Lee, and Emory, most tax law professors in the wider legal academy ignored my research. The few who took notice did so generally in order to either insult or marginalize my work. One particular example that I write about in the book occurred in January of 2002. I was a panelist on the tax section program at the Association of American Law Schools. I presented the marriage bonus penalty research that I produced while I was at Cincinnati, and that I was able to write and have a data analysis because of the Institute for Policy Research. It was received well. The first audience question was directed at me. Dorothy, everybody knows your work is irrelevant because Blacks are poor and don't pay a lot of taxes. A hush fell over the crowd. The first person in my defense was a fellow panelist who said it was really important to understand whether tax policy has a racially disparate impact. The panelist later told me he didn't want me to have to be the first person to have to respond to the comment. Then it was my turn. I drew the microphone close and I said, well, if you're right, that means we want our children to grow up to be poor so they don't have to pay a lot in taxes. At this point, the audience burst out laughing. I continued, no, we don't want our children to grow up to be poor. We want our children to grow up to have lots of income that is either subject to the preferential rate or not taxed at all. To that tax professor, all Black Americans are poor when the overwhelming majority are not. That is one of the reasons why I wrote The Whiteness of Wealth, to show that the Black middle class and white middle class experience two different Americas. Even if poverty were eliminated tomorrow, our separate but unequal middle class reality would not change. But tax academics have company in thinking tax law is colorblind. Most tax reporters don't get it either. One recent example comes from the ProPublica series on the tax returns of the wealthiest Americans. The first installment described several wealthy taxpayers with pictures. Their faces were white and male, and not once was race or gender ever mentioned. Would we have Jeff Bezos if he were not white, but born Black and named Jamal Brown? Or Elon Musk or Mike Bloomberg? If they were not born white men, they would not be billionaires today. Why? Because the American system of building wealth is designed to produce wealth for white men. If you were to go back and look at each of their wealth creation stories, you would discover why in America it could only happen for a white man. The other ProPublica story that just jumped off the page was a story about billionaire sports owners who paid lower tax rates than their millionaires players. And you know where this is going, right? There were pictures. The owners were all white and the players were almost all Black. And again, no mention of race when race explains so much of how the story came to be. Unfortunately, tax reporters, with rare exceptions, are painfully off key for the moment we are in. One exception that I will highlight is Ben Steverman of Bloomberg Business Week, whose feature story on my research and the book in the March 15, 2021 issue was the first time a reporter took my work seriously. My final example comes from the New York Times, a June 12th piece about private equity and how a powerful industry conquered the tax system, completely ignored the role of race. That took a lot of effort because every picture in the story was of a white person with one exception, the exceptional Black guy who was elected president in 2008. The story talked about the special treatment in the form of tax cuts and no IRS audits, but did not acknowledge the reality that race matters. Private equity is overwhelmingly white and male. It is no accident that tax cuts and audit policies helped that industry. As I document in my book, there are lots of examples of tax breaks being crafted by rich white guys who wanted to pay less in taxes. Another place the New York Times reporters missed the significance of race was that part of the story discussing the non-existent audit rates of private equity funds. While we're talking about the rich white guys who do not get audited, let's talk about the people who do. Black earned income tax claimants in the rural South are far more likely to get audited. Here, ProPublica acknowledged race in their earlier 2019 piece that showed 5 counties with the highest audit rates are all predominantly African American, rural counties in the Deep South. Further, the audit rate is also very high in South Texas's largely Hispanic counties and in counties with Native American reservations. Finally, primarily poor white counties also have high audit rates. It's almost as if some business and tax reporters can only talk about race when we talk about the poor, but not if we talk about the rich. The serious harm in that approach is it makes how the deck is stacked in favor of rich white Americans all but invisible. Reporters need to do a better job learning about and reporting on race in their tax and business stories. As I close, I often think about my journey to get The Whiteness of Wealth researched, written, and published. Saidiya Hartman, Columbia University professor and MacArthur Fellowship Grant awardee, talked about finding freedom in her colleagues' low expectations. She stated, as a Black woman intellectual, I am at the bottom of the food chain. But within that space of no one taking me seriously, there was all this space to work. Her comments resonate with me. I have been toiling in the race and tax field for 25 years, marginalized, ignored, and insulted. Nevertheless, I persisted. My work being ignored gave me the space to produce The Whiteness of Wealth. My book shows that you cannot tackle the racial wealth gap without transforming our tax system. My aim has never been to impress scholars, but to change the world. And right now, from where I'm sitting, I like my odds. Thank you.
Well, thank you, Professor Brown. That was excellent, really quite excellent. Now we've come to the part of our program where we take questions and answers.
Perfect.
We take questions, you give answers.
Perfect.
And I notice a lot of questions have been coming through the chat. And as is our habit, which we've developed a little bit of expertise doing this virtually. Jenny Edelstein has been collecting the questions, and so she'll go ahead and ask them. So
perfect.
Take it away, Jenny.
Okay, thank you so much, Verna. I received this in an email. I am an African-American woman CPA. I have literally never met another African-American woman CPA in my entire career. Do you think that more diverse representation among the CPA industry could have a significant impact on tax policy? If so, what is your recommendation to accomplish this? To start a new pipeline of new CPAs requires about 5 years of study, including passing the challenging CPA exam. In your opinion, what is the most effective way to influence tax policy?
So first I'll say, I do think racial demographics are really important to think about. And last fall, I gave a talk to a group of CPAs, an accounting association, their diversity section. And the person who invited me has taken my concepts to his classroom, has taken my ideas and spread them abroad. So I totally think that it's important to get more diverse accountants looking at these questions, but I also think it's important for all accountants to think about this as part of their charge and asking the question, what role does race play in this? So yes, I think increasing the pipeline is important. I co-directed a pipeline program for law professors between 2011 and 2017. And what we did was we ran a boot camp of sorts, and we had promising future scholars of color come, and we prepared them for the job market, and we were successful 100% of the time. It was very labor intensive. So what I would say as someone who's not steeped in the CPA community, you know what a pipeline successful program would look like. In the legal academy, what it looked like was having people practice their paper, what we call a job talk, having them practice interview, and helping them navigate the unconscious and conscious bias they would face in the interview process. So I think it's important to increase racial diversity in the accounting field. And I think your last question was, how do we change tax policy? Well, one, we get the public better informed, right? So usually people hear taxes and they, leave the room, right? So having people understand that taxes are really important to dealing with the racial wealth gap, and whether you know it or not, it could very well be taking money out of your pocket. So you need to pay attention. And then lobbying members of Congress and making them understand that this is important and that we need changes.
Thank you for that. From an attendee, do you believe the married bonus versus married penalty as it affects Black couples was intentional?
So I think the marriage bonus was intentional with respect to couples like the Seaborns, married white couples. I don't think, so first of all, that's a great question. I get it a lot. And my answer is, I'm hoping some historian takes up my charge and goes through the historical record, right? To do a better job than I did, because I'm not a historian, to see if there was any legislative history that I didn't uncover that would suggest the answer to that question. I think tax policy was more intentionally done to benefit married white couples, and as a byproduct, it disadvantaged Black couples. But when we think about, the joint return in 1948, In 1948, we didn't have Brown v. Board of Ed. Separate but equal was the legal law of the land. We didn't have any of the Civil Rights Act. So it's not beyond the pale to suggest maybe Congress had an anti-Black motive, but it isn't necessary in my mind to really answer, to really respond to the question, to answer the question specifically, because you lose focus on whether they intended it or not. We know this is happening. And now that we know, what is Congress doing to fix it?
Thank you. From Austin Wishart, some defenders of the joint tax return claim that it incentivizes marriages, which in turn incentivizes having children. With US birth rates dipping to the lowest they have been in 40 years, and the growing need to replace a retiring workforce, do you envision a different incentive for couples to get married and have children if the joint return is eliminated? Maybe a child tax credit?
So I would say there's no empirical evidence that the joint return encourages anyone to get married. In fact, when we had the joint return introduced in 1948, I think the marriage rates were significantly higher than they are now. We've had the joint return in place since then. So it's the fact that there might be a public policy after the fact justification for the joint return doesn't mean it actually does it. So there is an argument that tax subsidies for homes encourages home ownership. But again, there's no empirical evidence to suggest that. In fact, economists who don't agree on much agree that tax subsidies for home ownership doesn't increase the home ownership rate. So I reject the notion that the joint return encourages marriage. But we know what happens with the joint return, and we know that there's a singles penalty because there's a joint return. And over time, there's an increasing percentage of Americans who are single. So if I were to predict anything, I would predict the growing numbers of single Americans are probably going to demand change in a way that benefits them, which is going to cut back on the bonuses for marriage. With respect to tax subsidies for children, tax subsidies for children exist whether you're married or not. We have a child tax credit that isn't dependent on marriage. We have an earned income tax credit that isn't dependent on marriage. So the subsidies for children don't require you to be married.
Thank you so much. From Deborah Linden, do you believe mass incarceration, particularly as to African Americans, starting in the 1980s, explains at least part of the racial disparities found in the impacts of the tax system? And do you have hope that major reductions in mass incarceration will help immensely to reduce the racial wealth gap?
So when I think about mass incarceration, I think about what that means. Well, one, if you have people in prison, they're not working. If they're not working, they're not contributing taxes to the system. So it's really against our financial interest in one sense, because they're not working outside and becoming tax-paying citizens. But it's clearly in the status quo's financial interest, or we wouldn't see so much money being spent on mass incarceration, right? So we have prison population that are prison labor, right? We have private prisons. So it's been referred to as a prison industrial complex. So there's lots of money in it, but it's not helpful or useful to the Black community, right? To starve us of our family members to, when you look at all of the people, mass incarceration was about so much often about nonviolent offenders. So, I think mass incarceration contributes to the racial wealth gap more than I would say the largest harm is with the tax system. I think the racial wealth gap, mass incarceration plays a huge role.
Thank you. And then how about expanding immigration to expand US workforce taxes paid and Social Security contributions?
Could that repeat that again?
Sorry, yes, I'm sorry.
No, it's not you. I'm trying to figure out the question. Okay, immigration, yes. Something
Yes.
I'm not an expert on, so let's go.
I think what the person's trying to say, I hear you. I think what they're trying to say is if we were to expand immigration to allow for more people in the US workforce, would that raise the taxes paid and Social Security contributions?
In theory, yes, the more people you have working, the more people pay into the Social Security system. So I'd say yes.
Okay. I think that's what I think. Yes. And then several people I just wanted to reiterate have really appreciated so much your comments. They say your work deserves respect and they hope that you achieve your goal of promoting justice through tax reform.
Thank you.
Awesome. Says thank you so much, Dorothy, and welcome back. She loved your talk. So many synergies with the student presentation given today in my bankruptcy class. How race matters and bankruptcy matters. We had much discussion about racial disparities in wealth, student debt, etc., and how that translates into built-in inequities under the bankruptcy code that allows, for example, for exclusion and exemption of millions of dollars in retirement funds and, in effect, no discharge of student debt with an impossible burden. And another attendee would like to know, how can we order your book?
Okay, so you can go to, let's see, Penguin Random House, The Whiteness of Wealth, and order it there. They have any number of links. So basically your favorite bookseller, you should be able to order The Whiteness of Wealth from them. With respect to the bankruptcy point, yes, Professor Dickerson at University of Texas wrote a piece years ago where she talked about the ideal debtor, and the ideal debtor for bankruptcy relief is a white debtor. And there's been lots of research since then looking at bankruptcy and race and how Black bankruptcy filers are put into one chapter of bankruptcy as opposed to another, and the chapter that they're often steered towards is not the best one for them. So yes, that much work has been done and much work is left to be done.
I had a question.
Yeah.
Oh, Chris Johnson has a question too, but my question really quickly, it's probably not quick, is how do you account for the media not seeing race when it comes to discussing wealthy people like Elon Musk and Jeff Bezos and looking at the way the tax system benefits them?
Yeah, I think the the media, if you look at those who cover tax, they tend to look like those who teach tax. Disproportionately white, disproportionately male, disproportionately clueless when it comes to race, and disproportionately disinterested in race. In fact, I've seen many a tax academic say this move of bringing race, gender, sexual orientation into tax is a bad thing, like tax is neutral and objective. And I think there's this idea that conflates class and race, that if Black people show up in tax stories, it's low income stories, that either the tax reporters do not think Black people who are high income have any differences compared to their white peers, or like that professor who told me my work was irrelevant, believe all the Blacks are poor, right? So it's either A or it's B or some combination of both. And now I'm going to tell you a funny story. So when we had a Black president, he published his tax returns. As someone who wrote about race, every April 15th for me was like Christmas because I got a Black family's tax returns. And there's nobody who's more of an expert, perhaps other than the Obama's accountants than me. Every April 15th, I would try to pitch a story to reporters explaining how the Obamas were paying higher taxes compared to their peers because they had so few dollars in the stock market, which made them like most Black Americans. Not a single reporter was interested in the story, not one. So I'd wind up doing a couple of op-eds and, every now and then when we get picked up. But there's this notion that if you have high income, then you're just like white Americans, and therefore there's no story there. When actually what the Obama's tax return showed is, compared to their peers, their tax rate was higher because they got income from wages and income from royalty income with his book sales, which is taxed the same way as wages. Couldn't get any reporters interested. They just, no, it can't be race. Okay.
That's,
Thank you.
oh dear, I'm shaking my head. Thank you. Just, and well, if we may, we'll finalize with one last question from Chris Johnson. What can be done to strengthen the IRS to improve efforts to collect tax revenues from wealthy people?
Yes.
We know that audit rates are low among wealthy people. They have the money for accountants and attorneys to help them.
They need increased funding, something Build Back Better was designed to do, but it didn't get out of Congress, right? So, well, it didn't get out of the Senate, to be clear. So we need more money added to the IRS, and then we need accountability on what the IRS is doing with their money. Because right now, what the IRS is doing with their limited audit dollars is going after earned income tax credit claimants. And that's not where the money is. The money is in higher income households. The money is in private equity, for example. So we not only need more funding, but we need accountability on the part of the IRS, something the administration could do tomorrow. The administration could direct the IRS to do different audits, to audit high income Americans. And it's been one of those things that it's not on anyone's radar screen. It's not something that's going to grab your attention. It's not something that's going to lead the news, but it's really important that we not focus our audit dollars on hardworking low-income Americans, which is what's happening now.
Okay, well, thank you so much, Professor Brown. Sadly, we have come to the end of our hour. As I said at the beginning, I knew that this was going to be exactly the kind of talk that the late Judge Marx wanted us to have at UC. So thank you for returning. Thank you for your excellent talk. And thank you for continuing to do this important work. And thank you all for coming. Take care.
Thank you for having me. Bye-bye.
Bye, nice to see you.